Welcome to The Explainer. Today we're setting the stage for a deep dive into a massive, fundamental shift that's currently shaking up decentralized finance. We're looking at how one of the biggest platforms in crypto is adapting to the incredibly strict rules of traditional finance, and, well, what that actually means for the future of on-chain trading. It is a fascinating evolution, so let's get right into it.
Okay, let's dive into this. The central question echoing through the crypto world right now is this. Is decentralized finance surrendering to Wall Street? For years, the absolute defining characteristic of DeFi has been that it's permissionless. Anyone, anywhere, with an internet connection could trade assets, no bank approval needed. But suddenly, we're seeing a major protocol demand approval to trade certain assets. It creates a pretty jarring tension, right? To understand why this is happening, we need to look past the dramatic headlines and examine the actual architecture being built.
Section 1. DeFi's New Identity Crisis, Building a Parallel Liquidity Market.
So there's a myth circulating right now that Uniswap is closing its doors to everyday users. I want to be clear, that's simply not true. Instead, what we're really witnessing is more of an identity crisis for crypto purists. Uniswap isn't shutting down its open markets at all. It's building a secondary, highly controlled environment right alongside them. Look at how these two realities now coexist. On the left, you've got traditional open pools. Anyone can trade automatically 24/7. But on the right, you have the new permissioned pools. Here, your blockchain address actually has to pass an issuer's strict allow list before a transaction can occur. Think of it like a massive public nightclub that just built a heavily guarded VIP room in the back. Both exist inside the exact same Uniswap building. They run on the exact same underlying technology, but they have entirely different rules of access.
And who exactly is hanging out inside this new VIP room? Well, the launch partners for these permissioned pools include companies like Superstate, Securities, and DAOGO. These aren't your typical meme coin creators. These are entities working specifically with tokenized funds, regulated securities, and traditional real-world assets. They are bringing traditional finance products onto the blockchain, and to do that, they absolutely need controls.
Section 2, Real Assets, Old Rules. The unbending nature of legal compliance.
Now, the crucial point here is perfectly captured in this January 2026 statement from the SEC regarding tokenized securities. A blockchain can operate around the clock, and sure, it can transfer a token instantly. But that underlying technology absolutely cannot erase the legal nature of what the token actually represents. If a token represents a share of a real-world fund or a debt instrument, the real-world rules apply. Investors must know who enforces those transfer rules. It's just a structural reality of the market. And this represents a massive paradigm shift. Previously, checking if an investor was legally allowed to buy a security happened on a website's user interface or maybe behind the scenes in some centralized settlement layer. Now, compliance becomes part of the trade execution itself. If an issuer has to enforce rules based on the specific jurisdiction or ensure an investor isn't on a sanctions list, a fully open pool simply doesn't work. Literally, one unregulated transfer violates the product's conditions. So on-chain compliance at the exact point of transfer becomes a structural necessity.
Section 3. How permissioned pools work. The mechanics of conditional market access.
So, how does this actually work under the hood using Uniswap v4 hooks? And this brilliantly illustrates the mechanics. It's basically a three-step process. Step 1, a user initiates a swap or tries to provide liquidity. Step 2, the smart contract pauses, and the v4 hook acts as that bouncer at the door we talked about, checking the issuer's specific allow list to see if your address is on it. Then, step 3, the trade either executes smoothly or it flat out fails based on your eligibility. Your self-custody of the wallet completely survives, but your market access becomes entirely conditional.
But there's a glaring challenge here. A blockchain address is not a complete identity system. An address isn't a person, right? Private keys can be stolen. A single institutional wallet might be operated by 10 different employees. Because of this, an entire complex identity layer has to exist completely outside of the smart contract. We're talking about investor registration, identity verification, address linking, recovery processes, the whole shebang. The permissioned pool only sees the final result, a simple yes or no. All the messy human errors and legal disputes, those happen entirely off-chain.
Section 4. The fragmented liquidity problem. Splitting the global pool.
But the ripple effects don't stop at access. In traditional open DeFi, a token's liquidity is one massive global pool. Everyone chips in, everyone trades. But with permission pools, a single asset's global liquidity will fracture into isolated slices. You might have one pool exclusively for qualified U.S. investors, another completely separate pool for European users, and maybe a third for international institutions. Even if the underlying token is the exact same, the global liquidity is split up based on jurisdiction and investor type. And this directly weakens DeFi's core promise of deep, seamless, borderless liquidity. And what you really should take away from this fragmentation is that different pools will inevitably produce different prices for the exact same asset. In a normal market, arbitrageurs jump in to equalize those prices and make a quick profit. But here, arbitrage requires dual eligibility. You'd have to be approved on multiple different allow lists to buy low in the European pool and sell high in the US pool. If only a handful of elite firms qualify for both, well, those price discrepancies could persist. This creates a highly lucrative business model for specialized, regulated market makers who actually have the resources to navigate all these different compliance lists. Section 5. Breaking the composability chain. The limits of money Legos. DeFi is famous for its money Legos. The ability for one asset to seamlessly plug into dozens of different protocols. You trade it, lend it, use it as collateral, all automatically. But it turns out money Legos fall apart pretty fast when corporate lawyers get involved. A permissioned security cannot automatically move into lending protocols, liquidators, or yield vaults. If Uniswap approves your address, that doesn't mean a separate lending protocol understands the issuer's restrictions. A liquidator protocol actually has to be legally eligible to receive the token if you default. So this beautifully programmable open system transforms into a rigid permissioned graph that starts to look an awful lot like traditional licensed finance. Open automated market makers, or AMMs, they don't care why you're trading. But a regulated market must actively manage exceptional real-world cases. Think about things like sanctions, court orders, mistaken transfers, freezing assets, fund liquidations, dividends, and share conversions. An open smart contract just ignores all of this. But a permissioned market, it has to be able to pause, reverse, or redirect assets to be usable by institutions. Resolving these real-world scenarios is what will determine if these products actually succeed, far more than the underlying code itself. Section 6. 2 markets, 1 infrastructure. The future of coexistence. Now, despite all these new rules, Open DeFi isn't dying. It's just getting a highly regulated roommate. As outlined in the April 2026 SEC guidelines, just having decentralized execution on a blockchain does not make your website's interface or your routing logic invisible to broker registration requirements. An AMM is no longer the entire capital market. It's just one module inside it. Securities, for instance, is already combining issuers, brokers, and stablecoins into one regulated chain. But the key takeaway here is that both these regulated assets and ordinary open crypto assets, like your favorite meme coins, will ultimately share the exact same technical base on Uniswap. The infrastructure remains neutral, even as the access rules completely diverge. So, I'll leave you with this final provocative thought to ponder. Uniswap has successfully given these 2 entirely different worlds, open crypto and heavily regulated traditional finance, a common trading mechanism. But the ultimate question remains, will this common infrastructure actually bring meaningful, massive regulated liquidity on-chain? Or will these strict, heavily fragmented permissioned pools just remain low-volume, isolated islands in the broader DeFi sea? We are definitely going to be watching closely to see how the market decides. Thank you so much for joining me for this explainer, and remember to keep questioning the mechanics behind the headlines.